Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. The S&P 500 posted its best weekly gain in nearly a year last Friday. What do you think were some of the factors that boosted the equity markets?
Well, good morning, Melissa. It really is around the Federal Reserve clearly telegraphing a rate hike so strongly now that our stock market seems to be ready, willing, and able to absorb a quarter-point rate hike. So that's the good news. It's also the perception that the stock market investors expect the hike so much now that if the Fed fails to raise rates, then the concern will be that we are not as economically as strong as we were perceived to be by the Fed. So we're going to be watching. We should see some renewed optimism continue into the upcoming week, and as long as there are no other global shocks, investors will probably stay in a good mood and will support the move that we had last week.
So do you think this good move will last till the end of the year? What's your outlook for U.S. equities as the year draws to a close, Dodge? Pricing in a Fed decision mid-month.
Yes, I think that the market is pricing in a Fed decision to start the interest rate rise. If it doesn't, then I think there will be a pullback and there'll be a concern. What is a concern is that longer term, the Fed might be raising rates precisely when the global economy is slowing down. But for now, between now and the end of the year, if there's a pullback, the reaction will be to buy pullbacks as opposed to having a more serious downturn. Because between now and the end of the year, we are in a seasonally favorable time. We have some holidays, we have retail, et cetera. So there's some really good reasons for the market to continue to look to the upside.
And what about into next year, Dodge? Could this year-end rate hike by the Fed can reverberate within equity markets into the new year, perhaps?
Oh, yes. Now you're talking about a whole new year. If you take a look at what has been happening, what you said was true. Last week was very, very powerful, and it had some breadth. But if you take a look, we really have been dealing with a narrow market. The top 10 stocks in the S&P 500 are up an average of 13.9%. Great, terrific. But the other 490 are down an average of 5.8%. So this is the largest spread that we've seen since the late 1990s. So if investors want to participate, you have to be very selective and to be in the selected stocks, which are very few. Going into next year, the question raises, will the narrowing of the breadth that we've been seeing change, reverse, and that will be a play between interest rates going up and the perception that our economy can support the interest rates going up and the perception of what is going on in Europe, how that will affect our interest rates and our economic growth. So next year is a much bigger question. But Melissa, you cannot short the market. You cannot anticipate what's going to happen because the season that we're in now has a much more positive tone to it.
Well, Dodge, let's talk central banks for a minute. You said the market has already priced in a Fed decision, a Fed rate hike in December. The ECB on Friday said it will do whatever it takes to raise inflation as quickly as possible. So what kind of month are you expecting December to be as both central banks meet for this policy decision? And it seems that they could head in different directions.
Absolutely, Melissa. The month is going to be volatile, both to the upside and the downside. I don't think that the markets have really priced in the full impact of the two central banks disagreeing as to or having to react differently to their economic situation. And you take a look at the Eurozone, you have a disagreement within the Eurozone. The Bundesbank president has expressed a sharply different view than what Draghi's been saying. So it's going to be a volatile month. And I suspect the volatility will be much shorter term in nature until both sides of the pond finally get into gear as to what they're going to do and to see what the reaction between the two sides will be.
And what about the bond and currency markets, Dodge? How do you see the divergence impacting these markets?
Volatility and divergence is going to continue. You're seeing, with the Eurozone stimulus, you're seeing a lot of additional bonds coming in, Euro bonds coming in now. I suspect that will continue. It's almost certain that the ECB next vote will be on December 3rd. Now that's when they'll probably move, very likely, and that's before the Fed will announce its decision. So there's going to be some volatility between the 3rd and when the Fed announces, and then after that, the market, the bond and the foreign currency, the FX markets are going to have to work out the new reaction, and it's going to take time. It does take time because you have two sides that are moving at the same time. So divergence, yes. Volatility, yes. And I suspect it's going to take up to 2 months for it to converge and finally come into some kind of agreement and movement.
So, Dodge, volatility and divergence, taking into account, what kind of tweaks are you making to your positioning in your 2016 portfolio?
Not trying to anticipate what's happening in 2016, Melissa. We have a period of a month to go through where the perception is much more positive. But I am concerned with the breadth that we're seeing in our markets. This is not the type of breadth that one would expect in the continuing bull market. So, and there's several, there's some really big risks that are going to have to be addressed next year. We see a potential devaluation of the Chinese yuan as they work through their economic weakness. Not saying it's going to happen. It's just a risk that the market's going to have to deal with. We also see continued weakness and the potential further fall in the commodity prices, particularly with crude oil. That's going to be a big risk. Bond yields rising faster than anticipated. Not terribly faster, but the perception that they're moving faster. I mean, we're going through the first tightening cycle that we've had in 7 years. We're starting from near zero rates. The instruments the Fed intends to use are largely untested. There are geopolitical risks. All this is going to play into the risk of bond yields rising faster than the market is prepared to handle. So going into 2016, we're going to be very cautious. We will continue to look for sector rotation. And as we get further into the second quarter, then I think you're going to see the market more comfortable in taking longer-term investment decisions.
Thanks so much for your time. That was DodgeDorland, Chief Investment Officer of Landor&Fuest Capital Managers in New York on BFM 89.9.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.